Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I'd like to welcome Ryan Barker. Thank you, Ryan, for joining me on our Fortuna Advisors podcast, Create More Value.
Thanks, Greg. Pleasure to be here.
As CEO and founder of BERA Brand Management, Ryan and his colleagues have revolutionized brand measurement with a heavy emphasis on what he calls brand love, which goes beyond traditional measures of awareness and even the very popular Net Promoter Score to better articulate the true elements of brand differentiation. The company's predictive artificial intelligence technology provides a proprietary BERA score that shows how a brand is performing in the market, possible risk factors, and growth opportunities. It also has the ability to accurately forecast a brand's future trajectory. These real-time insights are designed to clarify the impact of brand equity on an organization's financial performance, which of course helps management create more value. When I met Ryan over 5 years ago, I was so impressed with their approach that we developed ways of integrating their metrics into some of the valuation analyses we can do for companies. To get started, Ryan, maybe you can explain what you mean by brand love and how such insights can help executives develop better business plans and make better decisions.
Yeah, absolutely. So, brand love is true loyalty. True loyalty is the emotional and behavioral connection, whereas a lot of people think loyalty is just behavior alone. And the way you can calculate to understand if someone actually loves your brand is based on four components. They have high degrees of familiarity with your brand, high degrees of regard for your brand. They find the proposition to be meaningful and relevant in their day to day lives. And there's something competitively unique and special about you. And the reason love is so important, it might sound cute and fuzzy to finance people at first, is it pays dividends. There is tons of financial benefits that we can measure in real time. A couple of things. Love reduces price sensitivity. Love increases the ability for folks to try new goods and services. Love gives you forgiveness. God forbid your brand messes up. And love gets you to have folks recommend you to a friend. Those are just some of the financial benefits that brand love can yield.
You know, I hear you, and I've obviously been speaking to you about this for years. But when I look out at the world, it seems like the world is going the other way. People are worrying about like performance marketing rather than brand building. They're worried about digital advertising, which is not really advertising, but the emphasis is on the transaction rather than building the sort of stature of the brand. What impact is this having on brands and longer term performance? These trends of behavior.
Yeah, it's a great question. We were actually published in Harvard Business Review in June of last year regarding this topic that we wrote with collaboration of Kate Lamberton from Wharton, Jim Stengel, former CMO Procter & Gamble, and our very own Ken Favreau. So performance marketing, nothing's wrong with it. It's great. You can measure it in real time. The problem is measuring brand equity when you don't have enough data or resolution or the metrics that matter have been underinvested in. And so here's the issue. Performance marketing has been getting the lion's share of funds, and that works up to so far. And then ends up happening is you have to invest twice as much, 3 times as much, 4 times as much just to yield the same results. And what folks don't understand is brand building and performance marketing are two sides of the same coin. There's actually a cause and effect. And let me oversimplify, Greg. When you build brand love, you reduce the friction of the funnel that's so relevant in performance marketing. And when folks in the performance marketing team, if you give them the same brand building brief as the brand builders, it actually increases your conversion rate. So it's about getting the right optimization of spend between the two, but also understanding its cause and effect, and you can't silo the two.
That's interesting. I mean, as excited as I get about this, because I see, from our research how your brand metrics tie to valuation multiples and all sorts of things that are, hard to establish in the in a financial world. Um, I have at times found senior finance executives to be less interested in this than I think they should be. I find that um, maybe they're too short term or maybe they're too finance, but they don't understand the importance of this in terms of driving the sustainability of results. Has this been your experience? And what about CEOs also? I mean, what do you think about their interest in these metrics related to their brands?
Great question. I think we've seen a lot of evolution, especially over the last 5 years, and depending on the sophistication of organizations. Let's start with CFOs. When they realize that brand is an asset as opposed to an expense, and it's used in part of resource allocation, they are amazed and delightfully surprised that investment in brand can generate as high, if not higher, ROI than other forms of growth levers like investment into new products,
Hmm.
investing into new regions, going after new audiences. And it's shocking to folks, but they love the fact that you can have the same rigor in resource allocation when you put brand into the equation than other
Hmm.
components. For CEOs, what we've been seeing is brand is now showing up more and more as an executive KPI.
Hmm.
We can actually prove that brand has a causal linkage to revenue, short term sales, profitability, and ultimately total shareholder return, then why shouldn't that asset be part of the executive KPIs? And here's one of the things that blow CEOs' minds is it's actually a leading indicator. When
Hmm.
they see brand growing, they get excited that it's the manifestation of a lot of the operational levers working cohesively, as opposed to a lot of people thinking that brand is just simply a 30-second spot with a cute logo when it's actually more important than that.
What about the boardroom? Are these topics discussed adequately, you think, in the boardrooms of companies?
So, back to the degree of sophistication, more and more, especially large portfolio companies, understanding the asset value of a brand for the parent company and
Hmm.
the sub brands is very important.
Hmm.
When people are growing and they're creating new line extensions and creating new brands, at what point have we began to cannibalize the equity within the portfolio? Brand helps shed some light on that. So I
Hmm.
would say board members are, in fact, more and more excited about having that measurement in real time. And also from an M&A perspective, when they have to go buy another brand, understanding what's that going to deliver in terms of value creation to that organization.
Yeah, that's a great point. I've thought about that a lot in terms of if you buy a company with a certain financial profile and it has mediocre brand love versus another company with maybe similar current financial profile but really strong brand love, yeah, it should have a big impact on what you're willing to pay to acquire the company. Your likely results after the deal are so much better with the strong brand love.
Let me add one more piece to that. So we work with a lot of private equity and VC firms that are looking for undervalued brands. So there's strong love, but it might be a younger brand with not a lot of sales and growth yet, but there's a
Hmm.
lot of headroom.
Right.
They're asking for understanding the brand's opportunity in terms of putting some resources in there. Another piece I'll add quickly is large portfolio companies. What tends to happen is year over year, they put most of their lion's share in the two biggest brands and they increase it 5 to 10%. When there are some younger brands that have higher growth equity in love, and they're in the dating stage and momentum
Mhm.
stage, and with the right nourishment and investment, they can reallocate their resources there to have a higher ROI.
That's really interesting. That fits so well with so many of my observations as well. When you have a company that has, when I think about like the business units of a company rather than the brands, if it has two dominant business units and then three smaller ones that are often faster growing and more nimble and so forth, the large ones often just get way too much of the investment money just because they have a loud voice and they measure everything as a percent of sales and that sort of thing. But the value created per dollar can be so much greater in the small, more differentiated, faster growing, the disruptor rather than the disruptee, so to speak.
Absolutely.
Can BERA's brand metrics be included in marketing mix models? And I guess if you could start by explaining what a marketing mix model is briefly, and then ways that your metrics might augment them would be helpful.
Yeah, these marketing mix or media mix models are an econometric technique for resource allocation. So if you have $100 million media budget, how should I allocate my resources to TV, print, digital, social? And most people do that to set their budgets on an annual basis. It's pretty common. Multi-touch attribution is more on the digital side as well. Brand equity metrics, brand love can be integrated into both of those econometric models. And here's the big aha moment. Most people like to say that brand or love is about long term, right? We'd say wrong. There is a definite, measurable short term and long term contribution. And when you put love into these econometric models, it completely changes the optimization. You might be making decisions purely on short term or on long term based on the channels you think generate the highest ROI. But if you knew for every dollar spent in building equity, brand, love, and what that could yield, it changes the optimization results.
If I just stick with that for a minute, some of the media, and sorry, I misspoke, marketing mix model versus media mix model. Some of the media has a bigger impact on an immediate transaction, and some of the media has a bigger impact on the longer term value. And the optimal mix of those two is almost impossible to grasp with the traditional media mix models. Is that right? I mean, without metrics that really tell you about brand love or something significant about brand differentiation, how can you ever get the balance right?
Yeah, so great question. Look, there are pros and cons to a lot of these different econometric models.
Hmm.
The weakness of MMM is your inability to optimize by audience. You've got to wait 6 months to get the data, structure it, and cleanse it. You need 3 years of historical data. It's hard, but
Hmm.
it does work out well. Multi-touch attributions, you don't need the historical data. And the beauty of those models is you can understand by channel and the interdependency of those different channels on its contribution to sales. When you put love in that equation, ultimately the question is, what can I do to maximize short term sales while investing in future growth value? And if
Hmm.
you could have trade offs that sales today will be huge, but you're going to kill tomorrow, that's the institutional blindness that most folks have when they
Yeah.
fail to put brand into the equation. Hence short termism, which is a shared pain point I know that a lot
Yeah.
of organizations have.
Yeah. Very well said. I think that's really great. So, do you think the management teams of most companies have a good grasp on what their brands are worth and what drives that value?
I'd say no. I again, things are improving. More sophistication. The more that there is high resolution, high frequency, real time data.
Hmm.
When you put a value on the brand, most people think that's only relevant for M&A purposes.
Hmm.
As opposed to, what if you knew that you were growing love, sales were flat, but if you knew that love has a measurable economic contribution to total shareholder return, isn't that
Hmm.
ultimately what we're looking for value?
Yeah.
Sustainable, purposeful, profitable growth. And
Hmm.
so, a couple of things. Most folks don't expect brand to account for a large portion of total shareholder return. Here's what we found on average, it's between 5 to 25%. So, call it 15% on average across 200 sectors, Greg, is what we're seeing brand's contribution to the enterprise.
Hmm. That's pretty big. Yeah.
Imagine just
That's.
even a minor investment, a 1 point growth in love on what that
Hmm.
means to
Yeah.
massive Fortune 500 organizations. It's
Yeah.
amazing. And
Yeah.
therefore, it is an asset that needs to be measured, managed, and maximized. It's not an expense.
Hmm. I'd like to turn the topic a little bit to dig a little bit into your platform. So, in my opening, I mentioned that the BERA score is based on utilizes artificial intelligence. Can you explain to me what the role of AI is in your platform?
Yeah. So AI has become so popular these days. Everyone's talking about generative AI. Well, first off, we've been in the AI game for 5 years. We've been in the generative AI game for the last 2 years. So let me talk a little bit. Most companies come to us with their behavioral objective. I need to grow sales, share, profit, total shareholder return, website traffic, whatever it is. We've been using AI to capture the causal linkage between behavioral data, brand love, and other attitudinal data. And
Mhm.
we can link it from behavior to love to the positioning of a brand to the operational levers. AI allows us to have cause and effect on these sophisticated components.
Mhm.
Lately, we're using generative AI to contextualize things like if you knew that being cool will generate X% increase in sales, then you want to know everything there is about what does cool mean in my category and what
Mhm.
does it mean in culture. And we're using sophisticated large language models and generative AI to educate folks and to think out of the box. We also use generative AI to inspire brand builders on
Mhm.
what are the levers we can pull. So let's go back to cool. If cool generates share and profitability, what's the role of cool in my product innovation? What's the role of cool in pricing? What's the role of cool in messaging and distribution and customer service?
Mhm.
You have to operationalize your brand consistently at every touch point. And we are powering generative AI to inspire folks on that. And that's because we've got a decade worth in 200 sectors of norms that we
Mhm.
can use fact based data to see what's worked in the past, what's not, and to begin to simulate those what if scenarios for the future.
Mhm. That's really great. Um, so as we've covered now quite a bit of what we intended to cover, but there's one really big thing I want to bring up. Uh, Given what you do, working with lots of companies on helping them with managing their brands, I would imagine you get exposed to some really interesting situations, things that surprise you, either about the analysis, the data, the reactions of management. And feel free to do this on a no-name basis if appropriate. But what have been some of the biggest surprises you've experienced? What are some of the things that, if I were a board member of a company, I'd want to know that that's a possibility that that could happen because, I need to just be aware of these things.
Yeah. Well, there's no shortage. So let me tell you the things that really shocked me. Brand falls under CMO alone. Why do folks believe that brand is just primarily about communications? That is one of many touch points and levers that creates value. If brand is an asset, it's the CEO's responsibility and starts from the top, and everyone plays a role in it.
Hmm.
Sure, you could argue that the marketer or the chief brand officer has a primary role, but breaking down those silos, we still see so many silos in the organization that don't understand they're actually controlling positively or negatively affecting brand love's growth or decay, and there's a complete institutional blindness.
Hmm.
So there's a big pain point. Others, people believe in measuring brand once a year. Can you imagine running an organization and measuring sales once a year? You'd go nuts.
Hmm.
Brand is just as volatile as sales, especially when you have leading indicators, not
Hmm.
lagging. And that's another pain point that we see in organizations. And I guess the last one I'll hit is a lot of folks still believe brand is funnel alone, right? Awareness, consideration, and then advocacy and purchase. And they focus on awareness to be the primary variable for brand. That
Hmm.
would suggest that the loudest guy in the room is the one that ultimately wins, and that's not
Hmm.
the case. It's not the largest spender in the category. It's the one who can articulate in a differentiated fashion what makes you meaningful in
Hmm.
the marketplace. And so we see tiny brands all the time breaking and shattering norms because they properly measure and manage love, if you will.
That's really great. That's really great. I'd like to just explain a little bit for the benefit of the audience my initial views on this when I first met you and found out about your framework because I have more of a financial background and my focus is on helping companies try to drive top quartile total shareholder return. And when we first spoke and you explained brand love to me, I immediately thought to myself, this may be something that I can relate to financial performance. And we did some initial work and we could relate it to growth and margin and return on capital and things like that. But what was the most fascinating to me and potentially of interest to people was the research we did, which showed the relationship between your brand love metrics and valuation multiples. So most of what financial people worry about is driving the financial performance. And then somehow the market applies a multiple to it, and that gives you a share price. Well, if we now have fact-based, observable metrics that explain the multiple, we now have the ability in business management to track financial metrics and the drivers of the multiple. It's a much more holistic view of the shareholder value that's being created. There are times when the best path might be to not quite maximize sales growth, but to couple that with a big increase in brand love, and the multiple goes up, and that makes up for the fact that maybe the earnings didn't increase as much as it could. The short termism is the opposite, right? Where you drive the financial results to an extreme, sacrificing the brand love, but because you're not measuring it, you're not worried about it. And then you're baffled by the fact that the multiple goes down and your share price didn't rise as much as you thought it would. Um, I have been uh, wowed by that, and also surprised that more companies that we've met have not wanted to take that like integrated framework, up. And there was, in my experience, and when trying to explain this to people, there's always a bit of skepticism because it sounds almost too good to be true, I think. I mean, do you see this skepticism in your work? Do you when you I mean, what you explained already on this podcast sounds so great. How could anybody not want it? And yet, there are people that don't go down the path of paying to get these insights. What do you see as far as, I mean, are more people into it now? Is there still the same degree of skepticism?
There's still a lot of skepticism, and folks need to have proof, tangible
Hmm.
proof. To do that, you need to have high quality, high resolution, always on data with metrics that matter. And so everyone's going to want proof to show that causal linkage between love and business metrics. I think part of the reason folks are skeptical is that we've been burned in the past,
Hmm.
right? Folks have relied on vanity metrics in order to make decisions. And I think another piece here, Greg, is that the average marketer where brand tends to live today, rightly or wrongfully so, they're getting compensated on sales,
Hmm.
short-term sales, as opposed to enterprise value growth.
Hmm.
The people that are in charge of one of the most important assets in a portfolio, I believe, are getting compensated on the wrong metric. And so
Hmm.
you're almost telling them focus on short-termism, focus on short-termism. Yet brands about monetizing the lifetime value of a consumer and maximizing and tickling those
Hmm.
heartstrings. So I think the skepticism remains. I think it's part of our own faults in compensation at the executive level. And until folks can begin to integrate those into those models and see the proof,
Hmm.
um, I appreciate the skepticism.
Yeah, yeah. No, I can see that. One last question. I want to clarify something that you just said. You used the term vanity metrics. What did you mean by that?
So if sales is deteriorating, typically what happens, folks go to blame marketing. Marketing then goes to blame the agency. What do they do to defend themselves? Well, look at the amount of engagement I have. Look at the amount of people that says they're willing to recommend me to a friend. Look at the number of tweets I have. Nobody cares if sales is deteriorating. They want to understand investment in marketing communications, investment in brand. What is the causal linkage to sustainable growth?
Hmm.
And so when you come to a CFO or an FP&A as a marketer with this vanity metric where there's no causal linkage, you lose credibility. And that's how the industry has been for so long. People
Hmm.
have relied on vanity metrics. Today, technology allows us to measure brands and consumers' relationships in real time, down to the zip code. And so there's little excuse. And more people are getting on that train. And you don't have to be a big spender with deep pockets. Younger brands that are more digitally inclined, they're getting on the brand love train.
Hmm. Hmm. Well, that's really great, and that granular insight by zip code. That to me, because not everybody in every zip code sees the brand the same way, and having the information to be able to fine tune it at that granular level is really awesome. So with that, we'll wrap up here. And we've been speaking with Ryan Barker from BERA Brand Management. Thank you, Ryan, for joining us. I really appreciate the conversation. It's been very interesting.
Thanks for having me on, Greg. I really appreciate it. Take care.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.